Hello, everyone. Welcome to the Modeling Financial Incentives in SAM webinar. My name is Paul Gilman. I'll be the presenter today, and I also have colleagues from the SAM team who will be helping answer questions. This is the second in our series of webinars for this year. The next one will be at the end of the month on modeling hybrid power systems. You can register for the webinars on the SAM website on the events page, and we will be posting recordings of the webinars on the appropriate videos page on the SAM website at sam.nrel.gov. And this video is being recorded as well and will be posted. If you have questions, please use the questions box to type the question, and we'll read it and answer it during the Q&A session when I finish my presentation. Or we may just answer your question by typing a response in the questions box. So I'm going to start with a presentation that I hope will take about 20 minutes or so, and then we'll leave plenty of time for questions and answer and discussion. I'll start with a brief introduction to SAM, and then an overview of financial incentives, and then I'll show you how to set them up in SAM and where to find their effects on the model in the results. And then I'll show you what we're planning to do as far as updating the incentives for the fall 2024 release. So SAM is a free desktop application for modeling renewable energy projects. It's available for download from the SAM website at sam.nrel.gov. NREL's PV Watts calculator is a related tool. It's a web calculator. It also has an implementation in the desktop application, and you can access SAM programmatically through the PySAM Python package. And the source code for SAM is on GitHub repositories. You can learn more about all of this by going to the SAM website. SAM is used by a wide range of people from all over the world. So SAM can model 3 types of incentives. We have tax credits, depreciation, which is a type of tax deduction, and cash payments. And incentives may be provided by different providers, whether it be federal, state, and local government, or electric utility, or any other entity. And the rules for incentives depend on the provider. So SAM is set up to model a wide range of incentives from different providers, but an important point is that it does not automatically choose options based on the provider of the incentive. So you need to understand the rules for the incentive and then choose the correct options to model it in SAM. And some of the features for incentives are US specific, particularly when it comes to tax credits, but those US specific options can be turned off. So it's possible to use SAM to model incentives from all around the world. Tax credits reduce a project owner's tax liability. There are 2 types of tax credits. The ITC, or investment tax credit, applies in year 1, the first year that the system operates. And it's usually calculated as a percentage of qualifying costs. And in the US, the federal ITC has the effect of reducing the tax depreciation basis by 50% of the ITC amount. And then a PTC, or production tax credit, applies in years 1 up to a specified number of years, and it's calculated in dollars per kilowatt hour of electricity. So for tax credits, you can specify whether you can specify an ITC and PTC by year. So that gives you some flexibility in modeling the tax credit. The ITC effect on depreciation basis can be turned off or on, and you can specify the ITC as a dollar amount. So depreciation, another tax-related incentive, it's a tax deduction that applies over some number of years based on the cost of an asset. Different types of property qualify for different classes of depreciation. And in the US, renewable energy equipment qualifies for depreciation under something called Modified Accelerated Cost Recovery System, or MACRS. So this is an accelerated depreciation schedule. And the depreciation amount is calculated on the depreciable basis, and it's the cost of qualifying property less any credits or deductions that the tax rules allow that require be deducted. And an important point about both depreciation and tax credits is that SAM assumes that the project owner earns sufficient income to fully use the tax credit and depreciation benefit. SAM has financial models to model financial structures for tax equity financing, partnership flip, and sale leaseback models. But it's important to note that SAM doesn't really have any information about the project owner's total income, so it assumes it has sufficient tax appetite to use these benefits. Now, cash incentive is just a cash payment to the project. It might be a grant or a rebate. It might be renewable energy credit, or any type of cash payment to the project. And there are 3 types of cash incentives. The IBI and the CBI both apply in year 0. The IBI you can specify as a fixed dollar amount or as a percentage of the total installed cost. And the CBI is specified as $1 per watt of installed capacity. And then a production-based incentive, PBI, applies in year 1 up to the specified number of years, and it's specified in dollars per kilowatt hour of electricity. And then as far as options go, the cash incentives may or may not be taxable for both federal and state tax purposes. And then the IBI and CBI may or may not reduce the ITC and depreciation basis. And the PBI may be available for debt service. So these are all options that you can choose. And again, SAM doesn't automatically choose these options. There just isn't a good source of information that the software could use to make that choice automatically for you. So for example, if you're modeling a utility rebate that is not taxable but does reduce the ITC basis, you have to be sure to choose the correct options for that. So here's a screenshot of the incentives input page. This input page is the same for all of SAM's financial models. The top section has 2 columns for tax credits for the ITC and the PTC. You can see that you can specify credits for both federal and state taxes. And then for the ITC, you can specify whether the ITC reduces the depreciation basis or not. And some of these boxes are checked or not by default. I'm showing the default state of the incentives page, but you'll want to be sure to check and uncheck those boxes as needed for your incentives. The cash incentives here, there's 3 groups of inputs for IBI, CBI, and PBI. And for each type of incentive, there's up to 4 different providers. And then you have a column of checkboxes to determine whether the cash payment is taxable or not for federal and state tax. And then for the IBI and CBI, you have checkboxes to determine whether the incentive reduces the basis used to calculate depreciation in ITC. And then finally, for the PBI, there's checkboxes here to determine whether the cash payment can be used to service debt. And then the depreciation input page shows the different depreciation classes. There are 6 options here, plus a custom one, so you can create a custom depreciation schedule. The first 2 here, the 5-year and 15-year makers, these are specific to US tax law. And the default allocations here are for a utility scale PV system. And they show most of the equipment in the project is considered renewable energy equipment and solar energy equipment that qualifies for 5-year makers. So this 90% accounts for the solar energy equipment, which also qualifies for the ITC. So the ITC qualification basis is 90% of the total depreciable basis. And then the remaining allocations are for other equipment in the system that's not solar energy equipment. There's a column here for bonus depreciation. By default, it's set to 0. But if you're modeling a project that's taking bonus depreciation, you'll want to change the percentage here, and then check the allocations that to which it applies. All right, so that's the overview of incentives. Next, I want to go to Sam and show you what it looks like in the software. And this is the wrong case. Let me get the right thing up here. Okay, so this is a SAM file that I've set up with 2 cases, and I've labeled the cases PTC and ITC. We're going to look at the PTC case first. It's a PV Watt single owner case. So this is for a utility scale PV system. And this is for a project in Phoenix, Arizona. And it's a 100 megawatt PV system. It costs $1.16 per watt DC to install. It's about $116 million. And we're going to run the financial model over a 25-year analysis period. And this is financed with debt. We're using sculpted debt, where the size of debt determines on the cash available for debt service. And it's an 18-year debt repayment period. And we have some other assumptions here: construction financing debt and reserves. But we're going to be focusing on the incentives. So the incentives page is here. And this is for the default PV single owner case in SAM. We assume that the project takes the PTC. It's 2.75 cents per kilowatt hour over a 10-year period with a 2.5% escalation rate. And there are no other incentives. And then for depreciation, this is just the default depreciation that we saw on my slide a few minutes ago. So if we run the simulation, we can explore how these incentives impact the results. So whenever I run a simulation, I like to check the metrics table in the summary tab to make sure things look reasonable. Our performance modeling results look reasonable to me. But for the financial model, we want to make sure that we have a positive net present value if we want a profitable project. We also want to make sure that the internal rate of return is reasonable. So this is 9% internal rate of return in year 20, or a 10% internal rate of return at the end of the project. So those are reasonable numbers. And then we want to make sure that the size of debt is reasonable. So it's a 42% size of debt. So the project would have to be able to find someone to lend 42% of the cost of the project. So those all look reasonable. And then we can look at a little more detail here using the project after tax cash flow graph. So this is kind of a snapshot of the financial health of the project. In year 0 here, we see the equity investment. This $71.7 million is here. And then we see the effect of the PTC. So we have the 10-year PTC. So that's resulting in positive cash flow for the first 10 years. And then here we see the effect of the our 18-year debt repayment period. So after 18 years, we get our cash flow goes up again after we stop making those payments. And then we have some smaller benefits here from things like insurance deduction and these other depreciation classes, and of course the revenue from electricity sales. And then we can dig further into more detail by going to the cash flow tab here on the results page. And to see the effect of the PTC, we're going to want to go down to the project returns section of the cash flow. And the after-tax returns here shows the federal PTC income. So we can see that, we can see the dollar amount in the first 10 years. And then to see depreciation, we're going to want to go down to the income tax section. So here for state income taxes, we can see the state depreciation. And for the federal income taxes, we can see the federal depreciation. And you can see that Sam is treating both in the same way. And then this table down here shows us the depreciation basis calculation. So we can see the dollar amount allocated to each depreciation class for both state and federal taxes. And then over here, we see the final depreciable basis for both state and tax purposes. And then if we want to go into even further detail, if you're running SAM in Windows, you'll see a Send to Excel with Equations button above the cash flow. And if you click this button, what it does is it opens a pre-prepared file that comes with SAM that replicates the single owner financial model using Excel formulas. And by clicking this button, you export data from your SAM case here to that workbook. So this is the workbook with data populated from my SAM case on the Inputs tab. So this is all information from SAM. And then on the cash flow worksheet, we can see the cash flow model. It looks similar to the cash flow on the results page in SAM. But here we have formulas, so we can trace through how things are calculated. So we can scroll down to the after-tax returns to see the PTC calculation. So here we see the PTC number, but we see how it's calculated. And then our depreciation tables are down here. We can see how the depreciation basis is calculated. So if you want to be able to understand better like where this number is coming from, you can use this Send to Excel with Equations to explore the calculations in Excel. So that's our PTC case. In this file, I have another case here an ITC case, so I'll switch over to that. And this is the same model. It's a PVWatt single owner model, but on the incentives page, I've changed instead of using the PTC, we're using the 30% ITC. So if we switch between the cases, we can compare those two input pages. And then if I want to verify that this is the only difference between these two cases, I can use the inputs browser. So on the file menu, if I click inputs browser, this shows me a list of the inputs in the two cases that have different values. So I'm looking at show different values. So this confirms that the only variables that are different in these two cases are the ITC and PTC. So let's run a simulation for the ITC, and I get a warning message when the simulation finishes saying that the net present value is negative, and this might be a problem. So let's check that out. If I go to the summary tab, there's my negative net present value. So that's indicating that this project is not profitable. It costs more than the value of the project. And here's the after-tax cash flow. We can see here's the ITC, and here's the accelerated depreciation, the 5-year makers. So kind of comparing these graphs between the PTC and ITC, you can kind of get a sense of the difference in the magnitude of the positive cash flow. And then if we dig into details on the cash flow tab for the ITC case, we'll see the ITC amount here under after-tax returns. So the ITC amount is $33.5 million. And that's calculated, the ITC basis here is shown in this table. So the ITC qualifying costs are 111 or so $million. And the ITC, 30% of that is the ITC amount. And then the ITC reduces the basis for the depreciation. So our ITC basis here is $103 million, whereas for the PTC, the ITC basis is $120 million. So the ITC, one of the effects of the ITC is that it reduces the depreciation basis, which can have a significant impact on your finances. So that's all I have prepared for the presentation, and I'd like to open it up for questions or comments. And
thanks, Paul. I think the first question that would just be a short demo is showing where the difference between the depreciation settings for the single owner and other front of the meter financial models versus some of the behind the meter financial models.
Great. So yeah, I've been demonstrating the single owner financial model, and I'll add a case here for a commercial case. So this would be a behind the meter, like a commercial building. So I'm using the PVWatts PV model just because it runs fast. And so the single owner financial model is listed here under PPA. So this is for what we call front of meter financial models. They sell power to an off-taker to earn revenue. And then the distributed financial models are for systems that operate behind a utility meter. And the purpose of these projects is to reduce the system owner's monthly electric bill. So if we look at the commercial financial model, So I'll just rename this case to commercial so I can keep track what I'm doing. The depreciation for the commercial financial model is on the financial parameters page, and you'll see that it's a much simpler set of inputs. You just choose the depreciation class or type, and you can only choose a single one. You can't allocate it. So we're just assuming that the entire project, the entire cost of the project qualifies for 5-year makers in this case. So it's a simplification. And then in the cash flow, you'll see the depreciation is reported here. So it actually shows the depreciation percentage and then the depreciation amount. And the incentives page is the same as we saw for the single owner model.
Great, thank you. The next question was a user requesting a demonstration of what happens to a financial model when the first year bonus depreciation is applied.
Okay, so we can do that just by, and I encourage you to do this when you're using SAM. If you have a question about the impact of something, is just to try it and look and see what happens. So let's say let's say that there's a 50% bonus depreciation and that it only applies to the 5-year makers class. So when I run a simulation here, and if we look at, so it shouldn't affect the depreciation basis. We can see the bonus depreciation amount reported in this table here. So that's $47.5 million. And then in the after-tax returns, or no, sorry, down under income taxes. So let's look at the federal income taxes, the depreciation. Then we see this, there's our bonus depreciation in year 1, which is 47,000 for the makers, and then there's an additional 10 million or so for the other depreciation classes that's kind of buried in there.
Thanks. The next question is asking about showing the residential financial model and comparing that to commercial.
Okay, so the commercial and residential financial models are actually behind the scenes. They're the same model. There's just a couple of differences. So let me add a residential case here so we can see. So one difference is that homeowners don't get to depreciate equipment because they're not operating a business. So I need to go to the correct page. So the financial parameters page here, this is for the residential case. There's no inputs for depreciation. And then the other difference is that for residential, you can choose the loan type. So this determines whether loan interest payments are considered a tax deduction. So for a standard loan, interest is not deductible, and for a mortgage, it is. So I guess that's another incentive that I didn't mention is the debt interest deduction. That's an incentive that SAM assumes applies for commercial and front of meter financial models, and for residential, it's an option.
Thanks. There aren't currently other questions at this time, so if you have a question, please type it into the questions box. I don't know if Paul, if there's anything else you wanted to show while we're waiting for, oh, here we go. Are there any future plans to link to the Desire database?
We wish. That it's certainly something that we are interested in, and their older version of SAM did have a link, but it's a question of funding to maintain that database and to provide it in a format that can interact with software applications. So it's something that's in discussion, but I'm not aware of any funded projects yet to make that happen. I don't know, Brian, if you have any insights into that.
No, yeah, we don't have any funded projects to make that happen. The next question is, are there PTC, ITC differences with residential modeling? I'll just answer that quickly. The way the US tax code is structured right now in the Inflation Reduction Act, typically, even though the SAM input allows for a production tax credit, if the homeowner is taking the incentive, that only comes under the residential tax code as an ITC. The way that a PTC could be applied to a residence would be if it had a third-party ownership structure, which is covered by the host developer model. Paul, I don't know if that's worth a quick demo.
Yeah, so for the third-party ownership model, basically what you have is a residential or commercial building that's so the system is supplying the load to a residential or commercial building, but the system is owned by a third party that can take various tax incentives that the building owner may not qualify for. And so in this case, you could take the PTC, I think is what Brian is suggesting.
That's correct. And this, yeah, this calculates the PPA price that would be needed for a developer to meet that situation. All right, the next question is around internationalization and adjustments that might be made. It looks like the attendee is from Chile.
Right, so in general, I would say that you should be able to model incentives for any country. There may be some details of rules that apply to the incentive that SAM doesn't model, but typically we found that there's usually a workaround because of the flexibility, the way we set up these inputs. So for example, if you're modeling an investment tax credit and the way the basis calculations work in SAM doesn't really apply, what you can do is calculate the tax credit amount outside of SAM and then just enter it as an amount. But if there are specific incentive features that you're trying to model, please contact us at sam.support@nrel.gov and provide us the details of the incentive, and we'll help you see how to model that in SAM and potentially make updates to the model later to make it possible to do directly.
I think the other big one I would flag for internationalization is the maker's depreciation schedule is US specific. So probably you would want to reallocate your depreciation to whichever depreciation schedules apply in the international context.
That's a good point. Yeah, if you're modeling a project outside of the US and you're just kind of going with the defaults to get started, you'll want to come to the depreciation page and definitely change these. If depreciation doesn't apply, then you can just set all the allocations to 0. or if you're using a straight line, you could set the allocation for that to 0 or to 100. And then there's also this custom schedule, so you can set up any depreciation schedule that you like using the custom option. And I will mention just a sort of a technical thing about using the interface is that if you change the allocations here, so if I change this to 95%, you get this. It's trying to be helpful to tell you that you've allocated more than 100%. But then every time you want to change and you try to change something, you get the message, and that can be really annoying. So I would recommend setting the 5-year makers to 0 first, and then that makes it easier to change the other allocations without seeing that error message. Yeah.
I think the next one is related to the upcoming patch in terms of the difference between net capital cost and the installation cost, and whether incentives are being subtracted appropriately.
Right. So this is something we've been working on just in the last few weeks here. And I'm running a release candidate for a version of SAM that we are so close to releasing. We almost released it yesterday, but we found one last thing that we want to fix. So hopefully we'll have it out by the end of the week. But we added a new output variable. So I'm gonna just go back to our single owner PTC example here, and I'm on the results page, and I'm gonna go to the data tables tab here, clear this, and then I'm going to all right, so we've got a huge number of variables here that are about basis calculations. These are basically the variables that populate this table here, so that all these variables, all these numbers are individual variables that are reported here. But the one that I want to show you is the total depreciation basis prior to allocation and total ITC basis prior to qualification. So this is the basis, the starting point for the basis calculations for ITC and depreciation. And at the moment, they're both the same, but we may make changes in the future that cause these to be different. But you'll see that this basis is different than the total installed cost. So this is what is that, 124 million, if I'm doing scientific notation correctly. The installed cost is 116 million. So that you can see the depreciation basis is more than the installed cost. And that's because included in the depreciation basis are some of these additional costs on the financial parameters page. So for the moment in SAM, you can't see what costs are included here. But if you're working in Windows, you can use the Send to Excel with equations, and that spreadsheet on the cash flow tab, if you go to the depreciation and ITC basis calculation section of the cash flow, here's that total basis prior to allocation number. So it's 124,000. That's the same as this here. And here it shows what goes into that. So you can see that it includes things like a debt upfront fee, construction financing, and reserve funding. So that's the way things are currently working. For the fall 2024 version of SAM, we're going to be reviewing this basis calculation and probably removing some of these that aren't appropriate in the current environment. So that's that's something to stay tuned for in the fall version. But for this next update to the current version, you'll at least have a way to see what the basis is.
Thanks. The next question is back on the internationalization topic, particularly in the difference between some of the federal and state inputs. So the interplay between those two and how that might change in the international context.
So that's really going to depend on the country. The best I can say at this point is that if you're modeling a project in a given country, to familiarize yourself with the tax law that applies to renewable energy projects and with any incentives that may apply. And then you'll have to look through the incentive inputs. And this really goes for incentives in the US as well, in different states or localities. You'll have to see which one best fits the incentive you're trying to model. And again, if you're trying to model a specific incentive and not seeing how to do it, please contact us and we'll try to help you get that set up.
I think the other thing I would flag there is the interaction between the tax rates. Does SAM assume that the state tax is deductible from the federal tax?
So good point there. Yeah, a couple of things. One is that the tax rates themselves are on the financial parameters page. So there's a separate income tax and separate state tax rate. And then if we look at the cash flow, and let's look at the federal income tax, you can see that the state tax liability is, let's see. So this is considered as part of the federal income taxes. So this is a feature that's hard coded into SAM that's based on US, the relationship between state and federal tax in US tax law. Let's see if we look at it in Excel, we can state income taxes and then federal income tax. So you can see that the earnings before, what is that? Earnings before interest, taxes, depreciation, and amortization, EBITDA, and then the state tax benefit is considered income for the purposes of federal taxes.
Thanks. I'll answer just two quickly. One person was asking about nonprofits. It is possible to set tax rates to 0 to account for the nonprofit entity, and that will eliminate all of the depreciation benefits and similar other tax benefits. The tax rates do not update automatically with location. We aren't tied into any sort of tax database. So do check these inputs if you're changing locations between projects. I think, Paul, unless you have anything to add on those, do you have anything to add on those?
Yeah, just another benefit that you can model in SAM is a tax holiday. So if you don't have to pay federal income tax, say for the first 2 or 3 years of the project's being put in operation, you can use this little blue and gray button here to specify the tax rate by year. So then you could say, well, for years 1 through 3, the tax rate is going to be 0, and then it's going to go up to whatever the tax rate is for the remaining years in the analysis period. So in general, in SAM, you'll see some of these on the incentives page too. When you see a little blue-gray button, that means that you can enter the value either as a single number or as an array of numbers. this case, it's annual numbers over the analysis period.
Thanks. As a general financial modeling question, what are some common pitfalls with net present value?
I think the main one here is that, if you just look at the net present value, you might be missing something. So you might have a project that has a positive net present value, but in order to achieve that net present value, the project has to have unrealistically high debt. So maybe more debt than you'd be able to, than a lender would be willing to provide to the owner. Or you might have a positive net present value with a very high PPA price, a PPA price that's much higher than the project could reasonably expect to negotiate. Or you may have, unrealistically high internal rate of return, like a 50% internal rate of return or something. So the main pitfall of net present value is not considering it in conjunction with these other metrics. So you want to look at the net present value, internal rate of return, size of debt, and PPA price. You want to look at all of those together. And if all of those are reasonable, then you can trust or put more trust into your net present value.
Great. The next question is around computing with foreign exchange rates. I think the user has a great feature suggestion of potentially adding a foreign exchange rate to display outputs in a foreign currency. Do you have any workarounds to suggest in the meantime?
Yeah, that's actually a good solution thank you for that suggestion, because the problem we have is we can't change the units. We cannot easily change the units that appear. All these dollar signs are hard-coded into the code in a way that there's not just one place where we can change it. So a very common feature request that we get is, I'd like to change the currency symbol. So we just don't technically have an easy way to do that, unfortunately. It's something that we've looked into and would like to do, but it's just not practical. The other limitation here is kind of a silly one, but it's meaningful, is the size of these input boxes. So for some currencies, you end up with very large numbers. And so making the user interface flexible enough to handle, small and very large numbers is just, obviously it can be done, but it's just not something that we want to focus resources on. Having an exchange rate would kind of solve that problem. Everything would be in dollars with an exchange rate. As far as workarounds, the safest thing to do is just to work in dollars. The reason I say that is because because of the default cost. So if you go to the installation cost page, there are a lot of costs here that are in the in the user interface by default. And if you wanted to switch to a different currency, you would have to be very meticulous about going through every single input and making sure that you change them all to whatever currency you're working in. There's also some dollar values on the financial parameters page, and some dollar values on the incentives page. So you'd have to be really thorough about making sure that you didn't miss any dollar values. So for that reason, we tend to recommend just sticking to dollars and doing, converting costs from your local currency into dollars.
Thanks. There was a question about benchmarking for some of the financial metrics in order to determine whether or not the values are reasonable. I responded to that in the chat because I wanted to include some links, but just mentioning that NRL publishes a product called the Annual Technology Baseline, which includes financial assumptions for a variety of technologies. So for example, the after-tax equity rates of return in that product could be used as a basis for comparison for internal rates of return. And then the Lawrence Berkeley National Lab publishes a historical time series of power purchase agreement prices. So that could be used to validate some of the power purchase agreement prices. Paul, anything else to add on that one?
Yeah, just that there are some privately prepared, or let's see, reports that are prepared by private companies that they tend to be really expensive, so not everyone has access to them. But if you work for an institution that does have access to some of those, those are also a source of that kind of information.
Yep.
While there's a pause here, I'll just take a minute to show what we're planning for the fall 2024 release with respect to incentives. We're gonna, as I mentioned, we're gonna kind of go through the depreciation and ITC basis numbers and make sure that we're up to date on what's being included in those. And then we're also going to make a few changes to the way things are calculated. So for example, when you combine an ITC, the investment tax credit, and a investment-based incentive, or a rebate or a grant, that we're reducing the ITC basis correctly. And then, right, so whether or not we should be including those debt upfront fees in the various basis calculations. The last version of SAM, we introduced hybrid power systems. We don't have good default allocations, based on the different types of equipment in the hybrid system. So we're gonna review that. And then again, just updating the basis calculations to make sure that we're including the correct costs.
Yeah, I think we're slowing down on the questions a bit, so we'll stay on for 1 or 2 more minutes to see if any other questions come up that we haven't addressed either live or in the chat. We'll probably call it there.
I did get an email earlier today from someone who was planning to participate about financial programs that are designed to incentivize renewable energy development. And sometimes what those programs provide is some kind of guaranteed financing, and that would express itself in terms of SAM as debt terms. So even though we don't really think of debt as an incentive, if there's a program that's providing a loan with low interest rates or finance-related incentives, you can account for those on the financial parameters page with the debt inputs. I do see a question there about the detailed PV model. Can IRR be calculated using the detailed PV model? And the answer is yes. The internal rate of return, basically the section of the summary metrics table here, from here on down, these are all financial model outputs. And those are going to be the same for the single owner financial model, regardless of what performance model you use. So if you use PV watts or detailed PV or wind power or parabolic troughs, whatever type of system you're modeling, if it's combined with a single owner model, it'll report the internal rate of return, net present value, and all these other financial metrics.
And there was one more question asking for a little bit more detail on how those loan product terms might translate into the inputs in SAM.
Okay. I mean, it's really going to depend on the product, but for SAM, SAM needs to know the size of debt, and then the loan term and the loan interest rate, and then there are fees associated with the loan. So those are the financial terms. And then for the single owner model, you can size the debt based on cash available for debt service, which is typically done for project finance. But it's also possible to specify the debt percent. So it may be part of the financing terms might be, the size of the debt is explicit. So you can, in that case, choose the debt percent option and just specify the size of the debt.
Great. There's a question about storage projects. Maybe, Paul, you could show the battery webinars page on the website.
Yep, let me just bring that up. So the SAM website is here. We have the SAM website is basically like its own application that you have to learn, but you can navigate through the different topics covered here. So under battery storage, we have a bunch of videos on battery storage here in SAM. And the recording of this video will go on the financial models page here. And we'll also have a link to it on the events page under recent webinar recordings here up soon enough.
Yeah, and then everything Paul's been demonstrating today applies to storage projects as well. I think the one noteworthy thing there is that the production tax credit is metered at the energy to grid. And so you need to be careful with hybrid projects and the production tax credit. And I think we have some warnings in the software if users try to do that. Oh, it's charging from grid. That's the one that we implemented the warning for. Yeah, that's right. There we go. All right, I think that's probably everything that we have time for.
Great. Well, thanks everyone. If you do want to get in touch with us, please feel free to do so on the SAM forum. I'm showing it here, sam.nrel.gov/forum. And you can also email us at sam.support@nrel.gov if you prefer to email us your questions. So thank you, everyone. Thank you, Brian, for helping with the questions. And we look forward to hearing from you soon. Goodbye and have a nice rest of your day.